Hello and welcome to the second workshop conducted by TCS for the CIMA Management Case Study examination happening in February 2025. So this workshop is focused on the P2 syllabus areas. So before we get started, let me brief you on the session plan for today. So we will be taking you through the P2 syllabus, the key areas that you should be looking at in preparation of the exam, and how these different areas could be tested in the context of Shinyglas in the upcoming examination. Thereafter, we will take you through a mock exam task from one of our own mock exams. So this is aimed at demonstrating from an exam perspective how a particular area could be examined in light of Shinyglas, and what could be the key points that you are expected to cover in your answers. And this, of course, will be followed by a Q&A session where you will be provided with the opportunity to raise any questions you have pertaining to P2 syllabus areas, as well as any other syllabus areas, or in general about MCS or preparation during the next 2 weeks for the examination. So that's our session plan for today. And let me also remind you about our series of workshops and webinars that we've been conducting. So we have 2 more workshops coming up, and the next one, as you can see, will be on Sunday. So I want you to please make note of it, because usually we've had the workshops as well as the webinars on Saturdays for the
Hello,
past 4 weeks, as you can see. But next week, there's a small
hello,
change in how we would be going about. So I would urge you to keep track of the date, and also to make sure that you attend the upcoming workshop as well. So thereafter, we would have our final workshop, which would also be on a Sunday. And I hope these details are with you already. All right, so let's get started. And we will actually be looking at the discussion of the P2 syllabus areas first. So first and foremost, I would like to take you through the key areas from the P2 syllabus that you should be thorough with in preparation of the CIMA case study examination. So let me take you through this document that we've compiled, where we are looking at the key syllabus areas as well as the coverage of those areas in our mock exams. So in this document, which is of course available as a free resource also in the TCS website, you will see that we have listed the key topics from each of the 3 subjects. And in today's workshop, we will focus on the list of topics that come under P2, because this is the focus of today's workshop. And of course, in the upcoming workshop, we will be looking at E2. So first, we could start with investment appraisal, and this is the topic of discussion today, because I was posted with a question in the last week's workshop pertaining to IRR, internal rate of return. So I thought maybe it's a good topic to be discussed today. So we would be focusing on a mock exam task from investment appraisal. So under investment appraisal, there are 4 key topics that we've seen the examiner has tested in the past. This could be NPV, net present value, IRR, payback period, as well as real options. Now, I'm not going to go into the details of these topics, because this would be the focus of the mock exam task. So I'll skip this for now, but I'm going to explain these in detail later on in the session. So moving on to a different syllabus area from P2, you will have the topic of responsibility centers. Now, this has been a frequently tested area. So this is about for internal management purposes, for performance appraisal purposes. When you have a divisionalized structure, when you're looking at decentralization of decision making, and when you establish strategic business units, or when you establish divisions, how should each division be classified for performance management purposes? So you have four options with regard to classification of the divisions as a particular responsibility center. You could consider as a cost center or revenue center, a profit center, or an investment center. Now, this is an important topic because you need to know which of these classifications would be appropriate in different contexts. Now, for instance, if you take Shinyglas, let's assume a Shinyglas sets up a new factory. We are looking at expansion. We are looking at increasing the production capacity. So we want to set up a new factory. So if this factory is to be considered as a separate division within the group, what would be an appropriate classification? So you could be presented with a scenario as I just mentioned, and you could be asked openly about the different options, or you could be very specifically asked what would be the advantages or disadvantages of classifying it, say, for instance, as a cost center, which would be the most appropriate classification for a factory which only undertakes manufacturing. So you could be presented with new developments, and you could be asked to advise the management on the appropriate type of classification of the responsibility centers. So that's why it's important you be prepared with the different uh, responsibility centers as well as their appropriateness, together with the pros and cons of each of these responsibility center classifications. Now, don't worry, we've got you covered. You can access our first mock as a free resource. It's available on the TCS exam platform as well as on the TCS website. So you can attempt a task which relates to responsibility centers. In fact, section 4 of the mock exam deals with a task on responsibility centers. So I would suggest you try that if you still haven't. Thereafter, you could also be tested on the performance measures or the KPIs that we could use to measure the performance of different responsibility centers, as well as if there are any other developments in the business. If you're looking at expansion, it could be about managing a team. It could be about managing a particular project. What could be the appropriate KPIs, performance measures, right? So remember, KPIs must be specific. So it should fit into the SMART category. So you could be sometimes presented with KPIs, and you could be asked to interpret or evaluate the results based on the KPIs. At the same time, you could also be asked to recommend appropriate KPIs with justification. Now, the examiner likes the term justification because more often than not, whenever you are required to provide recommendations, you are always required to justify your recommendations. So I suggest you be prepared to be able to tackle such a scenario in the examination. And moving on with regard to performance measures, we could consider a holistic approach to managing performance in the form of a balanced scorecard. So, balanced scorecard, the beauty of this framework is that it considers both financial as well as non-financial performance measures. Now, it is often misunderstood by some students that balanced scorecard only focuses on non-financial performance measures. No, they also include financial performance measures. That's why we say the balanced scorecard is a holistic approach to performance management. And if you look at Kaplan and Norton's balanced scorecard literature, they've very clearly said that it's not only about the four perspectives a business should adopt, be flexible in how they apply the framework. If you identify that there's a fifth perspective or a sixth perspective that your business should consider specifically, you could incorporate that also into the performance management framework for the company. So it's important that you are thorough with the different perspectives of the balanced scorecard, starting with the financial perspective. Then we look at the customer perspective, internal business or operational perspective, and thereafter learning and growth perspective. So under these perspectives, we would be developing KPIs to ensure that the KPIs lead towards the achievement of the critical success factors. And when you achieve the critical success factors, you are looking at the achievement of the strategy, which will in turn lead you towards the achievement of the business objectives, which are, of course, connected to the vision and mission of the organization. And furthermore, with regard to performance evaluation, you could also be tested on benchmarking. And one more thing that I need to add, we had one particular examination task where the examiner had used only the word scorecard. So some candidates had a small confusion as to what is being referred to as the scorecard. So it was basically the balanced scorecard, but the examiner opted to word it as scorecard in the task. So just be prepared. Ideally, it should be worded as balanced scorecard, but as sometimes we refer to in business context, it could also be referred to as a scorecard. So it's a performance measurement framework. So coming back to benchmarking, this is also something very important because when you're looking at competitors, when you're looking at internal business processes, there is every possibility that you want to evaluate your practices against the best. It could be the best internally or it could be the best externally. So we want you to make sure that benchmarking is understood from a practical perspective, because the questions are not going to be you have to explain what are the different types of benchmarking and what is the process, but it would be more practical. For instance, what could be the challenges of performing a competitive benchmarking exercise at this level of the examination, at the management level. You are required to understand the implications of applying some of these technical concepts in real life. So that's why if you look at the past variants, you will see that these areas are not tested from a very theoretical perspective, but with application to a real business context. And moving on, we have transfer pricing. That is an extremely important area. We've seen this topic being tested almost in every examination diet. Sometimes we've seen students rule out this topic of transfer pricing because they assume that it's not relevant for the company. They actually come up with a good argument, which of course sometimes would make sense. You could say, based on the precedent, we don't see a scenario where there are internal transfers. So simply put, transfer pricing comes into the picture when you have a divisionalized structure. So going back to responsibility centers, and let's say you have two divisions. One is the manufacturing division and the other is the buying division. So when there's a transfer of resources from one responsibility center, which is evaluated on its own based on its own performance, and that of another division, which is also evaluated on its own based on its performance, there is this conflict of how do we record this internal transaction or the internal sale, because every division will want to maximize the profits from these transactions. So the selling division, the responsibility center, will want to sell it at the highest possible price if it's classified as a revenue center or a profit center or an investment center. Meanwhile, the buying division would want to buy it at the lowest possible price, because if you can buy it at the lowest possible price, once again, your profits as a division will improve, and therefore you can show better performance compared to the other divisions. So how do we balance this? How do we make sure that we achieve internal transfers? At the same time, we make sure that both these divisions are treated fairly in terms of how they profit from this transaction. So transfer pricing involves setting a price to record this internal transfer of goods or services. I repeat, goods or services. It is often misunderstood that transfer pricing comes into the picture only when you have a physical product or a component or a material being transferred from one division to another. That is true, but even services, even employees can be transferred from one division to another division on a temporary basis. One division could provide a service such as a professional service in the form of maybe research or maybe in the form of IT support. So these would also be considered as transfers within the divisions. And each of these transfers consume resources for the division which provides them, and therefore those divisions would want a price for these resources that are being offered. So this is where transfer pricing becomes relevant. So I would urge you to be thorough with the different types of transfer pricing methods that we could use. And once again, the relevance of these different types of methods. We have market-based, cost-based. We sometimes use marginal cost-based as well, and then we have full cost. So even under cost-based, you have at least 4 different options. And you may be expected to advise on what is appropriate based on the scenario presented to you in the examination. So we've tried to incorporate this into our fourth mock examination. So I'm not going to go into the details of what question we've included because some are yet to attempt our fourth mock. But this is something that you should definitely cover in preparation of the examinations. Because if you look at this area, it's a vast area in the syllabus, and it is something that at the management level in the organization that you are expected to handle. So that's why it becomes very, very relevant for you. Moving on, we also have activity-based management or ABM. You need to have a holistic idea about what activity-based management is. So it starts with ABC, activity-based costing, but this is more holistic. This is actually about managing based on activities, identifying cost drivers. So what we would recommend is for those who have done operational case study, you would be thorough with activity-based costing. In fact, activity-based management is discussed, but in a very light context. But here, you could be expected to demonstrate your understanding of activity-based management in much more detail. And thereafter, you could be looking at cost transformation techniques. So remember, this is one of those latest additions to the syllabus. When I say latest, it actually is in the syllabus changes that CIMA made in 2020, because that was the syllabus change where all the subjects went through changes, and the new CIMA case study examination structures were introduced. So this was something that was introduced as part of the new syllabus. And simply cost transformation techniques, if you are examined in your February examination, just remember this is simply about the CGMA cost transformation model. So the framework identifies 6 areas or 6 aspects that a business should focus on in terms of cost transformation, achieving cost competitiveness. So sometimes your question could be worded as cost transformation techniques, and don't be in the dark. It simply refers to the CGMA cost transformation model, which is covered in the syllabus, because it's ultimately that framework which is covered in your P2 syllabus. Furthermore, target costing, and for sure, this has also been a topic that has been tested in every examination sitting, as in for every pre-scene released, one of the 6 variants at least had a question on target costing. It's a very useful costing approach. We refer to it as an outside-in costing approach. It's a very practical approach in the sense that you look at, okay, how much is the customer willing to pay for this product? And how can we make sure that we satisfy the customer by offering the product at the price the customer is expecting, while making a desirable profit margin out of the product? So this has also been tested from different perspectives. Sometimes you are given numbers in the attachment, you are given information about a particular product or a service, and then you have a breakdown of the different costs associated with, the product or the service. You could be asked how we could apply target costing to make sure that, we achieve what we call the target cost. Or it could also be a question where you are being asked about the challenges or the difficulties that we will face in applying target costing, because it's always easier said than done. And it is under target costing that you could be tested on topics such as value analysis, functional analysis. So you need to be thorough with the target costing approach as well, because once again, this is a topic which is introduced to you only in P2. This is not discussed in P1, so this is not examined in operational case study. This is an exclusive topic coming in P2, and this is not examined in strategic case study either, because this concerns the middle level, and therefore it's a highly likely area for your examination. And moving on, we would also be looking at life cycle costing. So this is also a relevant topic if you're looking at products. So Shinyglas manufactures double glazed windows and doors. So it's a product. So something like life cycle costing is a highly relevant area considering our business model. So this is also an approach to cost management where you not only look at the production or the manufacturing costs, but you attempt to trace and track the costs of a product from the stage of research and development. So we need to understand that before a product is launched, a lot of investment is required towards the research of the market and to validate some of your arguments or concepts. And thereafter, you need to work on the development. You might have to look at different materials. You might have to look at different designs. You might have to work with suppliers to see whether you can come up with the product which is in your mind or which is under development. Then you will come up with prototypes. You might actually come up with different combinations with regard to material. So all these costs need to be recovered from the sale of the product. So it's not only about how much does it cost to manufacture it today, but how much cost have we incurred over the last year or so in developing, in bringing this product to life. Now, the customers who purchase this product now should also compensate us for the costs that we incurred over the last few months. And moreover, there can be certain products where when they reach the end of their life cycle, we would have to incur some additional expenses to remove or dismantle those products. Now, it could be the case with certain um, products which the customers want us to replace after a certain period of time. And countries which take sustainability seriously, they impose an obligation on the businesses to undertake uh, reverse logistics, where if the customer doesn't want the product, you have to dismantle or you have to remove the product from the customer's premises, and you have to make sure that the product is disposed of in a manner which does not affect the environment. So all these costs would need to be accounted for in determining the profitability of a product. So this is where life cycle costing becomes highly relevant, because we look at tracking the costs across the life cycle of a product, because a product goes through different stages. I hope you will recall the product life cycle. There is a research stage, there is a development stage, or we can say research and development, and thereafter we will look at the introduction stage. And if the introduction is successful, the product will have a growth stage, and thereafter the product will reach what we call as a maturity stage, and then it will reach its decline stage. So there are costs that a business will incur throughout these stages in the life cycle, and life cycle costing is an ambitious attempt to track all the costs across its life cycle. This will also include forecasting for costs that would involve the decline stage, and determining an appropriate price and calculating the profitability of the product over its life cycle. So that's about life cycle costing. And of course, you could also be looking at TQM. Remember, it will be an important topic of discussion for a manufacturer like Shinyglas, because remember, we've always been relied upon for quality, and we have been at the forefront of innovations. So an approach such as TQM facilitates just that. So it's another area that you should be revisiting and you should be prepared to tackle questions on. And moreover, business process re-engineering, well, there's every possibility that it is examined in the context of Shinyglas, because we are looking at an industry which will need to evolve. We will need to look at more sustainable solutions. We will need to look at more long-term solutions. And given the fact that we are the most innovative player in the market, we would always be looking at fundamental rethinking and radical redesigns. That's what BPR stands for. It's all about making sure you innovate, and you look at not gradual incremental changes, but you look at, sometimes radical redesigns, which could lead to enhancement of the quality of the product as well as cost savings for the company. Furthermore, value chain analysis, this, of course, sometimes you may write it off saying, okay, look here, this is a service organization, value chain analysis is not relevant. We can't do that, because if you look at Shinyglas, value chain is such an important part of the business. We have different categories of suppliers, and we have different approaches to managing our suppliers. And then we also have uh, the installers in the value chain. So we are working with a network of businesses, and all these businesses are involved in creating value towards our customers. So as you will know, in the modern context, it's not about Apple versus Samsung. It's about Apple's supply chain versus Samsung's supply chain. So the competition in today's world is between supply chains. It's not between individual entities. So if Shinyglas can offer more value through its value chain, then it will be able to hold on to its market leader position. So definitely a relevant topic. And it becomes even more relevant because Shinyglas is dealing with a physical product. So in a service organizational context, you could argue, the relevance of value chain, or its application is somewhat limited in scope. But in a manufacturing environment, in the industry Shinyglas operates, there is definitely a focus on managing the value chain, which is why value chain analysis becomes such an important topic. Pricing strategy, once again, relevant, important for us, because we are looking at a competitive market. So whatever pricing strategy that we uh, choose, it must be appropriate towards the market, especially the target market that each of these products are aimed at. So just be thorough with the different pricing strategies that we can use. There are market-based pricing strategies and there are cost-based pricing strategies. So you need to know the different types as well as when and where those are appropriate. We've had situations where, candidates misunderstand very simple pricing strategies such as skimming, uh, penetration. So there is often a misunderstanding about the skimming pricing strategy, penetration, and those are not acceptable at this level, because these are straightforward topics, and you should definitely be prepared well. Even if you come through an exemption route, the pricing strategy topic is not something difficult for you to understand. So please make sure that you're thorough with this topic, because if there is a task on pricing strategy, with your experience, with your professional experience and exposure, if you know what the different options are, you would be able to answer that task well, and you would be able to score marks well. It's not as technical as say a net present value calculation or an internal rate of return result. So therefore, just make sure you don't miss out on these easy marks that are on offer. Moreover, business risks and mitigation definitely tested. We've had situations where sometimes 3 or 4 of the 6 variants have had questions pertaining to business risks and mitigation. And the beauty of business risks and mitigation is that it is tested from a very practical perspective more often than not. So there are different types of risks, but you need to understand uh, which of these risks are relevant, applicable in the given context. So don't go with a theoretical approach towards answering questions on risks, and also be prepared with regard to mitigation. And when you are suggesting mitigation or risk management strategies, make sure they are practical. Don't get into theoretical suggestions towards managing risk. This is something that we often see in the answer scripts when we mark the mock examinations. When you are suggesting a risk mitigation strategy, just think, if I'm running this business, can I or would I do this? Is this advice sensible to me when I'm dealing with a particular problem? Now, for instance, Shinyglas, we have different types of risks that we are exposed to. For instance, installers, maybe they may not have installed the double glazed windows or doors according to specification, and as a result, we have issues with the window, and then we have warranty claims. So just look at it from a practical perspective. How could you address this issue of outsourcing installations to 40 independent companies, and how do we make sure that their installations are carried out to the specifications so that we don't have to spend on warranty claims? So it's important that you make sensible arguments when it comes to risk mitigation, and don't apply a framework such as the TARA framework, transfer, accept, reduce, unless your examiner is very specific that he wants you to apply that framework. So be practical, and then of course you would be looking at scoring the pass mark for a question on business risk and mitigation. And why we've listed out these different categories of risks is that sometimes when the examiner gives the question, the examiner could be specific. For instance, the examiner could say, discuss the product and reputational risks. Now, if the task is worded product and reputational risks, then you have to focus only on the product and reputational risks. Don't talk about legal risk, or don't talk about financial risk. It's not relevant towards the product or the reputation of the company. So it's also important to know what these different types of risks stand for, so that in case if there's a very specific question, your answer is specific to score the marks allocated for the task. Furthermore, you could be tested on sensitivity analysis, which is also something that I would be explaining in the context of the investment appraisal topic. And similarly, you could also be examined on stress testing. Now, this is also a new addition to the syllabus from 2020 onwards, and a lot of candidates don't have a clear understanding of what exactly stress testing is. It's similar to a framework such as sensitivity analysis, but in stress testing we are looking at extreme uh, adverse conditions that the business may be encountering. So a pandemic is a classic example of a situation which should be considered under stress testing. Extreme adverse situations and how the business can cope in such scenarios. So that could also be relevant for Shinyglas, because no business is guaranteed macroeconomic conditions which don't have any risk and which don't have extreme adverse conditions. It could relate to any aspect of the business. So this is basically the key subtopics, I would say, because if you take the P2 text, you will see that these topics have been covered in detail. What we've done is we've tried our best to bring these topics into a one-page document so that you have all the key points covered for you to skim through and make sure that you actually tick these topics off in preparation. So please remember, we've only considered the subtopics. There are topics that come under each of these. Now, for instance, as I told you, cost center, advantages, disadvantages. Now, although it has not been listed here, if you go to the topic of cost center, if you try to revise it, you will definitely see that, there are certain points which argue in favor of cost center classification and which argue against the cost center classification. So please be mindful of that as well. All right, so that's about the P2 syllabus overview in brief, and I will open up the session for a Q&A later, during which you can post any question you have pertaining to the syllabus coverage. But before that, I would like to take you through a mock exam task as well as the answer. So I would be looking at mock exam 2 that TCS offers, and this mock exam is themed on expansion. So if you look at the first section, we are told that the board is considering the construction of a new factory in suburban town, and this is to increase the manufacturing capacity. So the first section has questions on debt and equity. So this is from F2 perspective. And then if you look at the second subtask, we've covered real options. So this relates to P2 as I just mentioned today. So we actually bring real options also under investment appraisal. But in today's discussion, I would actually like to move on to section 2 of the mock exam, where you have been presented with some information pertaining to investment appraisal. So in section 2, we are told that 2 weeks have passed and you have returned to work after 2 days. And this email relates to investment appraisal and full-time salespeople. Now, this is also a likely scenario in your examination, remember, because there is always this HR-related topics that are important for you as managers. So please be prepared on that as well. So if you look at this section, we've covered a very technical task in subtask A, and it basically relates to the investment appraisal aspect of the syllabus, which is P2. And if you look at subtask B, we've actually incorporated a question on discuss the implications of recruiting full-time salespeople on Shinyglas's business model. And this was one of those tasks which was not very well answered in some of the scripts that we checked. So I hope the candidates who attempted the mock were able to go through the suggested answers, watch the masterclass videos where we give a clear overview of how you should be tackling these type of questions. But for today and for this session, we will focus on subtask A, which deals with investment appraisal. So let's read through the body of the email to get an understanding of what the backdrop of this task is. So welcome back. As you know, the board has been evaluating the proposal to construct a new factory from various perspectives. While you were on leave, I sought the assistance of the newly recruited finance officer to perform the investment appraisal for the construction of the new factory. And it was put forward for consideration at the board meeting yesterday. So while we were on leave, the finance officer, who is actually below us, and in fact, those who have done operational case study, the role that was assigned to you at the operational case study was that of a finance officer. So now you are promoted, now you are the finance manager, and we are told that the board is, however, seeking further information in this regard. Please refer to the board minutes for more details. So remember always, You have to refer to the reference material before you read the subtasks, because if you don't refer to the reference material, you will not get a clear understanding of what exactly you are required to do under each of these subtasks. So let's refer to the reference material. This is an extract from board minutes. And we are told that the board firstly considered the investment appraisal relating to the construction of the new factory. The senior financial manager presented the initial appraisal prepared by the finance team on short notice. So this is something that has been prepared on short notice. So I'm definitely expecting it to have some shortcomings if it was prepared on short notice, because that's where the task is heading. Right, so we see that Martin briefed the board that the initial investment required to construct the new factory is estimated to be $460 million. Okay. The investment is expected to yield a positive NPV of 31.8 million with a payback period of 4.5 years. Now, it should strike you that when the forecast NPV is positive, and when it reads as 31.8 million, well, to the naked eye, it is a project or it is an investment that we should pursue. That's the understanding that you should have as you read the reference material. Okay, look here, it looks fine. NPV is positive and it's going to give us 31.8 million. In other words, the shareholders' wealth in the company will increase by 31.8 million if the forecast figures turn out to be the actual figures, right? So based on investment appraisal, you can pursue a project with a positive NPV. And we also told about the payback period. Now, see, when it comes to the payback period, what we are looking at is how soon or how faster can we recover the initial investment. The initial investment. So the initial investment here is $460 million. And we are told that, look here, we can recover this amount in 4.5 years. Now, as you will know, when it comes to the payback period, this is about the sooner we recover. And the board of directors has to make a decision as to what is your target payback period. How soon do you want your investments to pay back? So if the board sets a target of 5 years payback period, then this project is acceptable because it is within the target payback period. But if the board sets a payback period of, say, 3 years, then this project is not meeting the target payback period because it will take 4.5 years to recoup the investment, and therefore it's not something that should be preferred. Having said that, remember, the biggest issue with the payback period technique is that it only considers how soon can we recover the initial investment. It's all about recovering this 460 million. What about the return? What about the income or the revenue that we are looking at from this project? Now, that's where the NPV technique becomes superior. The NPV technique looks at the whole life of the project. It doesn't only look at the initial investment. It also looks at all other expenses in the form of cash that will need to be incurred throughout the project life. It also considers all the income that we will generate from this investment. It accounts for time value of money. I'll come to that a little later. And it tells you, okay, in today's terms, if we pursue this investment, this is how much we are going to make. So it's too soon to comment on the payback period because I need the information pertaining to what is the target payback period of Shinyglas's board. Right, let's read further. The estimated cash flows used in the calculations were based on moderate level of demand for Shinyglas products. Now remember, NPV is all about forecasting. It basically investment appraisal, which looks into long-term investments. It's all about forecasting. So when you are looking at forecasts, you can take a very optimistic view You can plug in optimistic numbers, or you can take a very pessimistic view and you can look at, the worst case scenario, or you could, look at somewhere in between with a moderate outcome. So the finance officer has actually looked at a moderate level of demand. In other words, sales revenue is based on moderate level of forecast demand. And there were two other demand levels that had been considered. So we are told that there is this high best case scenario that was there. And there is this low worst case scenario. But the finance officer thought, no, I'm not going to take sales figures, which are the best case scenario, nor am I going to take sales figures, which are the worst case scenario. I'm going to pick the mid-range, the moderate level of demand. So it will make sense, if you look at it from a general perspective, but the examiner wants you to be thorough with how we technically proceed with an NPV appraisal. And when we technically do that, we don't pick one of these three. We have to pick a weighted average. So I'll explain that later, but I just hope you are basically understanding the material here. And furthermore, we are told that since the board decided to fund the project using a bank loan from Generous Bank at an interest rate of 11% per annum, 11% was used as the discount rate for the NPV appraisal. Now, that's also not appropriate. I'll address that in the answer discussion. So to discount the cash flows, we've used the bank loan interest rate, because that's how we are going to fund this project. So that's also not technically accurate when you look at how we work out the NPV. All right, let's read further. Meanwhile, Jose Philip, the operations director, raised concern that Shinyglas usually looks for a 3-year payback period. Now I have it. This is the target payback period. Because he's very clear in saying that Shinyglas usually looks for a 3-year payback period, and why this investment should be pursued when it does not meet the target period. Now, he has a valid point. The senior financial manager agreed to provide a comprehensive report to the board addressing all aspects of the investment appraisal. Now, I know one thing, this is coming to me, right? If the senior financial manager is promising something to the board, that means he's actually going to get me to do that. Right. Anyways, moving on, the board then considered the issue of high staff turnover among Shinyglas salespeople. Now, that's a given, because the pre-scene pretty clearly tells us that they work under stress. And it's a given when you have employees who are working under a stressed environment that we have high staff turnover or high churn rate. The sales director noted that this was impacting the company's ability to meet its sales targets. Obviously, she proposed that it is time for Shinyglas to consider recruiting full-time salespeople. Okay, that's basically the part of reference material relevant to the second subtask, but we will focus on the first subtask. Right, we are being asked to prepare a report covering, firstly, taking into account the investment appraisal performed by the finance officer. So this data here, what has been done so far, we have to take this into account. Provide your suggestions on how we can present a more informative investment appraisal to the board to determine the financial viability of the investment. So basically, consider this, what has been done so far, and how could we come up with a better, a more comprehensive, or as they term it as more informative investment appraisal to the board to determine the financial viability of the investment. So as I already mentioned, there are some issues in what the finance officer has done. So we will have to point those out, but we can't stop there because the task is worded in such a way. Consider this and tell us how a more informative investment appraisal can be done. So when you're planning the answer, maybe you could start by explaining the issues, the problems that you see here in what the finance officer has done. And thereafter, you could give some more points as to how we could come up with a more comprehensive, more informative investment appraisal to determine the financial viability of the investment, right? So first set of points will come from the scenario, and the second set of points will come from your knowledge of the investment appraisal topic in the syllabus. All right, that's not all. We also have another sub requirement. I always remind you, just be careful. A subtask can have sub requirements. So we are also being told, please also address the question raised by the operations director. Now, what is the question the operations director raised? Well, I remember he was asking, usually we look for a 3-year payback period, and why this investment should be pursued when it does not meet the target payback period. So ideally in your answers, you should have a separate topic, a heading, where you actually address the operations director's concern with regard to why this investment should be pursued. All right, first things first, we will look at the answer plan. And remember, we have answer plans as well as suggested answers. So I'm going to refer to the answer plan to give you the key points that you should be covering in this particular task. So first things first, you could basically start off by explaining what the NPV technique uh, represents, right? So as you can see, we are firstly, providing an overview about what does the NPV figure here indicate right now. Okay, here we are, we have the questions, and let me actually take every annotation out so that I could do it fresh. Right. Okay, so I've seen that it is expected to yield a positive NPV of 31.8 million. Now, the first thing that I would say is, look here, if we have a positive NPV, it means there will be an increase in the shareholders' wealth, provided all the forecast figures turn out to be actual figures. I mean, there can be small differences here and there, but we can only work with forecast figures at this point. And what I can say is that, look here, it's a positive NPV. The investment is viable. It is worthwhile pursuing it because the shareholder wealth at the end of the investment period or the project life, it will increase by 31.8 million. So that's the starting point. We could explain that. And we then have to point out some of the issues that we notice in what the finance officer has done. So before that, let me actually give you a bit more comprehensive explanation of what we do with the NPV technique. So those who have gone through P2 recap notes, you will remember that there are 4 investment appraisal techniques: ARR, accounting rate of return, then we have the payback period, then we come to the net present value, and then we come to the IRR. So the beauty of the net present value technique is that unlike ARR, the accounting rate of return, the NPV technique is based on cash flows. It is based on cash flows, and cash flows can be considered to be less subjective compared to accounting profit. ARR considers accounting profit. This means that we account for estimates such as depreciation, provisions. So there is more subjectivity when it comes to accounting profit. But when you consider cash flows, you take all those out. So when we perform an NPV appraisal, we take depreciation out of the equation. What we argue is that, look here, yes, there is a reduction in value. We will consider if the asset will have a scrap value or a residual value. And we will definitely take that into account when we evaluate the project, but we are not going to be recording depreciation because it doesn't involve a cash outflow for the business. So don't worry, no impact on your cash. Shareholders invest cash and shareholders expect cash in return in the form of dividends. So, let's go with that. So the NPV technique looks at cash inflows and it looks at relevant cash inflows as well as relevant cash outflows. In other words, you could argue that we are looking at incremental cash flows. So that's the most important aspect of the NPV technique. And thereafter, we would be considering the whole life of the project, the entire investment period. And sometimes, of course, you will consider it to the project to have an infinite life. So we consider the entire investment period, and this is an advantage in comparison to the payback period technique, because the payback period technique only looks at, okay, how many years does it take for us to recover the initial investment? That's it. It doesn't look at what happens after that period, right? So the NPV technique is more holistic in that it considers the whole life of the project. And we need to remember that the value of a pound today will not be the same in 2 years' time or 3 years' time or in 10 years' time. You might do the forecast and you would be like, wow, we are getting 10 million in 2035. Now, that's 10 years from now. The 10 million in 2035 would be worth something like 2 million today because there is inflation. So the NPV technique accounts for the fact that there's something called time value of money. And when we appraise investments, we need to be realistic. If we are going to get a return in 10 years' time, well, the numbers could say it's going to be 10 million, but its present value could just be 2 million. And we use a technique called discounting to convert the future cash flows into present values. So we consider the cash flows throughout the project life and we convert the cash flows into present value terms. In today's terms, how much is this cash worth? So investment today, so we were clearly told that we are going to spend 460 million today, and next year we will get a return. The year after we would get a return. We convert everything to a base year of today. And then we compare the cash inflows, outflows, because we have a comparable base. Year 10 is also converted to year naught. Year 7 is also converted to year naught. So we bring it to a common base and then we identify, okay, look here, when you account for time value of money, this is the actual cash flows. And having all these figures will help you calculate what is the net return. So consider this net return as similar to the net profit that we calculate in terms of accounting terms. So net profit will account for the revenue as well as the expenses. The net return and NPV gives you also accounts for all the income, all the expenses, but they are cash flow based and they are converted to present value terms. That's the beauty of the NPV technique, and those who actually involved in management accounting or treasury functions in organizations would understand that this is something that we practically use when it comes to evaluating long-term projects in corporate business environments. So that's the beauty of the NPV technique. And when it comes to the cash flows, we had a small issue, right? So as I said, we consider cash flows. These are forecast cash flows. And the finance officer had a situation where he looked at 3 different scenarios. When he had to forecast sales, that is cash inflows, he had 3 different demand levels. There was this moderate level of demand, and there was this high or the best case scenario as well as the low or the worst case scenario. Now, he has chosen one of these three scenarios, the moderate level. But when you are performing an NPV appraisal, what you're supposed to do is you are required to determine the probability of each of these three outcomes. So you need to identify the probability. Say, for instance, if the moderate level of demand is 50%, then of course, you identify the probabilities for all three outcomes. So let's say low is 20%, moderate is 50%, and high is 30%. And thereafter, you will look at the forecast sales figure. So let's say if the demand turns out to be low, then we would have 5 million in demand. If the demand turns out to be moderate, then we would have 8 million. And if the demand turns out to be high, 30% chance that it would be high. If it turns out to be high, it will be 10 million. Now you need to arrive at what we call as a weighted average. We multiply these forecast numbers by their respective probabilities, and we arrive at something called the expected value. So the mistake the finance officer has made is, without considering the probabilities and the expected value that comes as a result of weighting each of these outcomes by the forecast numbers, the finance officer has straight away gone and taken the moderate level of demand. So we will need to rework this NPV based on this approach. So that's what we've highlighted. So we've told that the cash flows, there's a small problem here. It has been based on a moderate level of demand, which is incorrect. Because when there are multiple outcomes, we should calculate the expected value. And this should be incorporated into the NPV as the sales figure or the cash inflows coming from the sales, right? And furthermore, if the board really wants to look at a more informative investment appraisal, what you could look at is, okay, now finance officer is telling us if the demand turns out to be moderate, we are going to have 31.8 million in net return. What if the demand turns out to be low? Shall we plug in the most pessimistic numbers and find out, would we still make a return, a positive return out of this investment? Well, you could do that. So even the worst case scenario, even if the worst case scenario is going to give you a positive NPV, that means this project is a less risky project, because even under the worst circumstances, you have a chance of making a return from the project. So remember, it's something that you could do because the board wants us to, tell how we could do a more informative investment appraisal. So we could do the expected value calculations, but of course we can also calculate an NPV considering a worst case scenario. And furthermore, we could also perform what we call as a sensitivity analysis. This is also sometimes referred to as a what-if analysis, and this has also been tested as a separate task in one of the past variants, what-if analysis. Now, what do we mean by what-if analysis? Now, in an NPV appraisal, we consider different variables. We consider the demand, that is the sales revenue. We consider different expenses. So there can be manufacturing expenses and there can be other different expenses associated with running a factory, the salaries, the utilities. So what if the salaries are 10% higher than our forecast? Right? Or what if the utility bills are 5% higher than our forecast? What if the demand, sales revenue is 5% lower than the forecast? What would happen to the NPV under different circumstances? What if analysis. So you consider one variable at a time. You consider one variable at a time and you look at the possible changes in that variable, because At the end of the day, you have to settle for one figure. But then you always understand it's a forecast figure, it could change. So under a sensitivity analysis approach in your Excel worksheet, you would make changes to that one variable that you pick at a time, and you see how it can affect the ultimate return, the net present value or the net return coming from the project. So if it is the intention of the board to have a more informative investment appraisal, right, this is what you're supposed to do, right? Look at how a possible change in one of the variables can affect the NPV. And thereafter, you will identify what are the most sensitive variables, right? Because sometimes a 2% change in a variable can render the NPV to be negative. Sometimes even a 10% increase in one variable may not render the NPV to be negative. So you need to identify the most sensitive variables. And once you know which are the most sensitive variables, once you know, okay, look here, salaries, if the salaries increase by say 7%, that means, our NPV will turn out to be negative, right? So in such a situation, you will always tell the management, you will always tell your managers, look here, guys, we have to keep the salaries on check, because when we worked out the numbers, we saw that if by any chance the salary figures increase by more than 7% compared to the estimates, then the NPV could turn out to be negative. So do all that you can, but make sure the salaries don't increase by above 7%. So once you know the sensitiveness of a particular variable, then you can actually focus on controlling that variable. So that's the usefulness of performing a sensitivity analysis. Right, moving on. As I already noted, we have to discount the cash flows to present value terms. And I will explain, if time permits, this on a later date, because it's a lengthy topic. The discount rate, the discount factor that has been used by the finance officer is the interest rate. He has actually used the interest rate, right? 11% was used as the discount rate for the NPV appraisal. And the reason for this is, since the board decided to fund the project using a bank loan from Generous Bank, the finance officer used that exact interest rate as the discount factor. Now, in NPV appraisal, we have to consider the weighted average cost of capital as the discount factor. It is inaccurate to use the interest rate as the discount factor. So you need to use the WACC. And this could be a discussion for a separate day, because it's another key topic in the syllabus, weighted average cost of capital. It represents the average cost of an entity's total pool of funds. Because remember, it may be that this new factory is fully funded by a bank. It doesn't mean that your shareholders are going to say, look here, never mind, you funded this new factory using, the lender's money, and therefore we don't want a return from this new investment. That's not how, corporate finance works. So whatever new investment that is being undertaken, regardless of how those investments are funded, you need to always calculate, okay, what is the average return that this investment should generate, so that we pay all the equity as well as the debt holders of our business, right? So there is what we call the cost of equity, which is the share holders' expectation pertaining to the dividends from the company. That's cost of equity. And then we have the cost of debt, which is basically the agreed interest rate with the loan providers. So here, the 11% is only the cost of debt. We need to generate this 11% return, so that we pay the bank, but we shouldn't forget that there are also equity holders, shareholders waiting for their share of the return. So we have to consider both cost of equity, the dividend percentage, as well as cost of debt, the interest percentage, and we arrive at what we call the weighted average cost of capital, which is basically the average of all the costs of finance used in the business. So that's what weighted average cost of capital represents. And I will keep the explanation very brief. But as I pointed out, the company will use the total pool of funds to operate the business. And the funds cannot be isolated. And therefore, it's appropriate to use the weighted average cost of capital so that we generate sufficient return from the investment in this new factory to pay both the shareholders as well as the lenders. Right? That is why we have to use the weighted average cost of capital. And under normal circumstances, the cost of equity is higher than the cost of debt. So what would happen is if we used the weighted average cost of capital, then we would be using a higher, generally, it would be higher than cost of debt, right? So it would turn out to be a lesser NPV in that case. Right, moving on. That's basically all the details we have pertaining to how the NPV appraisal was carried out by the finance officer. But we could also suggest, if you want more details, you can also calculate what we call the IRR in addition to the NPV. So while the net present value is similar to net profit, IRR, the internal rate of return, is similar to the net profit margin. This considers the relative return or the percentage return from the investment. So rather than arriving at an absolute figure of, say, here 31.8 million, which is the absolute figure here the finance officer has calculated, you can look at as a percentage, how much return does it yield, right? And this is basically what was asked from me in the previous week's workshop, right? What do we mean by saying that IRR also indicates by how much the cost of capital can fall before the NPV of the project becomes zero? Now, remember, we use a discount factor, and the discount factor that we use is the weighted average cost of capital. Now, you need to understand that we use a particular WACC figure based on a forecast, right? We are looking at the next 5 years or 10 years, and we are looking at, okay, this is what the weighted average cost of capital would be for our company. And we are also using that weighted average cost of capital based on 3 assumptions. Right now, due to time constraints, I will not go into the details of the 3 assumptions. That's a separate task. Actually, it has been a 40% task as well linked to weighted average cost of capital. So we would not be able to discuss that today, but it's covered in our master classes. But please remember, this WACC figure may turn out to be different when you consider the whole life of the project. So the IRR, the percentage return, if the percentage return is higher than the WACC, right? So remember, WACC is the average cost of an entity's total pool of funds, right? So if the WACC is, say, 20%, and if the IRR is 25%, this is a situation where, on average, your shareholders as well as your lenders should be paid a 20% return on their funds. And the new investment, the factory, is going to generate a 25% return for us, right? So that means this is a viable investment, because the return that we are supposed to pay is 20, and the new factory is going to give us a return of 25%. So nothing to worry. We can comfortably move on with the investment. And this is where the margin of safety argument comes, right? Now, the WACC of the business remains at 20. Assume when you calculated the IRR, right? So let's say you are considering two options. You can construct the factory in suburban town. I think that was the location that was stated. Yeah, construct new factory, and I think it was in task one. Yeah, suburban town, right? And the alternative option is for you to construct the factory maybe in a different location, in a in a location which gives you better costs. In other words, cost savings. So when you look at the IRR for a different location, a different project, it is 28%, right? So project A or suburban town is 25%, project B, maybe the new town is 28%. And the cost of financing your business stands at 20%. Now we say that the project with the higher IRR is better, right? Because you have a margin of safety of 8% here. Because I want you to understand NPV is a forecast and the IRR is also a forecast. We are forecasting the return to be 25% here. We are forecasting the return to be 28% here. The actual could be lower. The actual could be lower. So when the forecast is 28, and when the cost of financing the business is 20, well, the margin of safety is relatively higher compared to a 20 versus 25 scenario, right? So that's why we say, in addition to the NPV, calculate the IRR also, right? So when you calculate the IRR, when you see that the IRR is, say, considerably or significantly higher than the WACC, that means you have a higher margin of safety. Actually, we don't use the term margin of safety here. I've actually, used the term here to give the idea to candidates that who may be coming from the exemption routes, because in terms of corporate finance, we don't really use that term here. So that's why I've said it's similar to margin of safety, because we also have candidates who have opted for the value pack, so they don't have access to the masterclass videos. So for them to understand what do I mean by here, right? I've actually said it is similar to margin of safety. So that's the idea here. And that's how IRR can be useful to present a more informative. That's basically what we were asked to do, right? To present a more informative investment appraisal. All right, I think we have one more requirement that we need to address, that is coming from the operations director. Operations director had a question. When Shinyglas usually looks for a 3-year payback period, why this investment should be pursued, right? I see some questions coming up. I'll take those during the Q&A session to make sure that the flow of the discussion is not affected. So let me also discuss this and conclude. Right, now we are told that the payback period for this project is 4.5 years. And the target payback period is 3 years, right? Now, here's why this company may want to do this project, regardless of the payback period, right? It's one thing to do with the limitations of the payback period, because the payback period only looks at the length of time it takes to recover the initial investment, right? It does not give you an indication about, okay, how much return will this generate, right? So that's basically the drawback. It does not consider the ultimate return or the net return coming from the project. And when it comes to investment appraisal, more than how sooner or how faster we can recover, more than the length of time, right? We have to prioritize what would be the net return, right? So that is why, although the payback period is higher than the target payback period, the company may want to pursue it, right? So we have to consider the net return from the project, and the net return here is positive, right? It's a positive NPV, and that means it increases shareholder wealth, because shareholders are not looking to recover their investment. They are looking at generating a return. They are looking at wealth maximization from investments. And that is why we are arguing that, look here, NPV considers the net return from an investment. And that is what shareholders want. And therefore, a project with a positive NPV is financially viable. And therefore, the company can proceed. On the other hand, we also need to explain what does the payback period really indicate in terms of investment appraisal. It just looks at how soon we can recoup the initial investment. So it's basically a measure of liquidity and risk, right? Quicker the recovery, sooner the recovery, lower the risk. That's basically what we calculate payback period for, right? And we also need to understand that Shinyglas has had only one factory all this time. And we are going to construct a new factory. Now, this investment is not something similar to what we may have done in the past decades. So in the past decades, we would have done different types of investments, but definitely not the construction of a new factory. So for those different types of investments, we may have had a target payback period of 3 years. But we need to understand that the payback would differ from investment to investment, right? Now, if you're going to, as a company, if you're going to invest in new machinery, the time it might take to recover the cost of machinery would be different to the time it might take to recover the cost of acquiring a delivery truck. You can't consider the payback period of a delivery truck versus a machine. There are different types of investments, and we need to understand the fact that the amounts would be different and the use would be different, and therefore we will have to patiently look at the payback periods. So that's why we have to argue, look here, we understand that the operations director remembers the fact that in the past we've looked at 3 years, but do understand that the payback will differ based on the nature of the investment, right? And that is why we are looking at prioritizing the NPV. But it's up to the management. If the board thinks, look here, 4.5 years is a risky time period, and there can be so many changes that could happen during the 4.5 years. So let's not risk the investment. Well, they can, because none of these methods will force you to make the investment or not make the investment. It's always up to the management to consider the outcomes of these investment appraisal techniques, but it's their call whether they want to proceed with the investment or not. So that's basically the discussion pertaining to the mock exam task. Considering the time, we've already utilized about 1.5 hours, so we'll actually save some time for the Q&A session also. And if you need similar explanations to other tasks in the mock exams, I would suggest you to check out the the premium pack that we have, because the premium pack includes the master classes. So we have 20 master classes, and what I did today is one sample of it. So we look at the answer discussions for all the 6 mock exams, and you will have access to these answer plans also. So these answer plans could become extremely helpful closer to the exams when you're trying to recap the key points to cover when questions relate to certain areas, especially when it comes to P2, F2 technical areas, rather than trying to go through the suggested answers document. These answer plans could become extremely useful, and they provide the structure behind the answers as well. So you still have time, and I would urge those who have not yet checked out our resources to look at the two study options that we have, and especially for those who are coming through exemption routes, such as FLP and Gateway, the premium pack would be of use. And the added advantage here is that you will also have one-on-one tutor feedback on 3 mock exams, mock 4, 5, 6. Actually, we've started to get some of the scripts, and we're actually feeling it that, students are keeping up with the answer the study plan. And this also includes a pass guarantee provided you fulfill certain criteria. That is mainly about sticking to the study plans and completing the tasks that we assign to you. So you can check that out later. And if you are confident of your, brought forward knowledge, and, if you only need these resources, you can also check out our value pack. So we would also like to tell you that our results have turned out to be exceptionally good last sitting, and you can check out verified reviews on our website, which have been posted on Trustpilot. And this is actually one of the candidates whom we believe aced the exam, considering the fact that the candidate started preparing just 2 weeks before the exam. At a situation where the student had booked the exam and had no way of rescheduling it, so had to go with the exam, and opted to invest in study resources, and was able to successfully pass the examination. So that's about our products and our services. So let me open the session for a Q&A, and I will pause the recording to facilitate the discussion. So thank you all for raising your questions, and we appreciate your time as well as your feedback. And let me remind you that you can reach out to us on these platforms. And if you want to join the WhatsApp group, I will share the link as well. But you could simply drop a message to this number, and we could share the link right away with you. If you need a study plan personalized, you need any advice, you can reach out to us on WhatsApp on this number. So you can take a screenshot, and you can reach out to us on this WhatsApp number. Of course, this is available on our website as well, the contact details. And for those who may have joined for the first time, let me remind you of the social media handles. Especially check out the YouTube and TikTok if it's available in your country. This is because we post certain video clips which would summarize the pre-seen content, and which would have certain discussion points which would be helpful in preparation of the exam. So that's all from us for today. We have one more workshop coming up next Sunday, same time. So see you next Sunday. Till then, good night. Take care, and have a
Thank you.
great
Bye-bye.
Monday. Thank you. Thank you.